Someone is sitting at the table with two tabs open. One is the rental they actually live in. The other is a cheaper property they could maybe buy somewhere else. And for a second, it feels like the shortcut finally makes sense. By the end of this video, you will have a 3-test filter for rent vesting in Australia, when it can still work, when it becomes fragile, and when the tax story is doing too much heavy lifting. We will use a plain example, renting at $650 a week while holding a $580,000 investment property that can be around $10,000 to $12,000 negative before tax. Not fantasy numbers, just the kind of model people actually need to run. The first reframe is simple. Rent vesting is not one housing decision. It is two decisions stapled together. Where you live has to work for your life. What you own has to work as an investment. That is why the idea is so tempting. If buying where you live feels impossible, buying somewhere cheaper can feel like progress. You are finally on the ladder, you finally own something, but the split does not disappear. You still pay rent where your real life happens. Then you also carry the investment loan, vacancy risk, repairs, insurance, management fees, and whatever state taxes apply. So test one is this: can the property survive without heroic tax assumptions? A deduction is not the same as cash landing back in your account. If a property is $12,000 negative, that does not mean the tax office hands you $12,000. The loss may reduce taxable income under current rules, but the benefit depends on your tax rate, timing, and the law that actually applies. That matters in 2026 because the negative gearing and capital gains tax debate is still moving. If the reported changes pass, future established property purchases may not get the same salary offset treatment. Treat that as policy context, not a foundation. The foundation is less exciting: rent, interest, vacancy, management fees, repairs, land tax, insurance, and the price you paid. If those numbers do not work, the tax setting is not a rescue boat. Test 2: model the state taxes state by state. Rent vesting makes it easy to compare only purchase prices. This place is $580,000, that one is $950,000, but that is too thin. Land tax thresholds, surcharges, transfer duty, rental standards, notice periods, and repair rules can all change the holding cost. The right page is usually the state revenue office, not a social media screenshot. Test 3 is the one spreadsheets often skip. Can you handle the emotional split? You may be an owner on paper and still a renter in daily life. You might fix someone else's dishwasher as a landlord while waiting for your own property manager to approve a small repair. You might own an asset and still ask permission to paint your bedroom. That is not a reason to reject rent vesting. It is a reason to price it honestly. If renting where you live gives you better work access, school stability, family support, or breathing room, that life value counts. Now add the 2026 policy fork. If the reported changes pass, the established versus new build distinction becomes more important. Established properties may lose some future tax usefulness. New builds may receive more favorable treatment, but a new build is not automatically better. Builder risk, settlement valuation risk, body corporate costs, thin rental history, and inflated package pricing can eat the benefit before the tax discussion even starts. The practical rule is blunt. If a property only works because the tax treatment looks better, slow down. Tax can be an extra variable. It should not be the life raft. Rent vesting is also competing with quieter choices. You could keep renting and invest in liquid assets, or you could keep saving and buy your own home later. Those options may be less exciting, but they are simpler. RentVest now buys earlier property exposure and leverage, but adds cash flow stress while you still rent. Renting and investing elsewhere gives liquidity but no property leverage. Waiting to buy later gives simplicity, but prices may move faster than savings. Before signing anything, run the property once with no tax benefit, 1 month of vacancy, and a 1% higher interest rate. If it becomes unlivable, the strategy may be too dependent on perfect weather. Rent vesting can still work when the life location and the investment asset are both deliberately chosen. Stable income, cash buffers, conservative vacancy assumptions, and real investment logic matter more than the feeling of finally owning something. It is weakest when it is emotional pain relief. If the real sentence is, "I feel left behind, so I need to own anything anywhere," ownership is not automatically progress. The final filter is 2 questions. First, can this investment property stand up without hype? Second, does renting where I live still make my life better? If the answer is yes to both, buying somewhere else can still work. If the answer is only yes because of a tax refund or a projected capital growth chart, the deal is probably not ready. General information only, not personal financial or tax advice. Before you rely on rent vesting, check the final law, your state taxes, and your own cash flow model. The goal is not to own anything. The goal is to own a decision you can actually live with.